Hello and welcome. Welcome to the Wealthologist Live, presented by Chris and Jacob at Hobart Wealth. Obviously, this is our monthly opportunity to sit down with you and talk with you a little bit about what's going on in the economy, dig into what's going on in portfolios and all that fun stuff. Obviously, this also is the last one of 2023. So you won't hear from us again until next year. But we've had a lot of great feedback on these specifically. People tend to really like these. So we're going to be doing these every month in 2024. Oh my gosh, isn't that hard to believe, Jacob?
It is. It is. Time's flying.
It is. But as we wait for a couple of more folks to join us today, I was trying to think of something kind of. I always think, what's a fun fact that people just desperately want to know about Chris? Because I know you're sitting there and you're thinking over the holidays, I want to talk to my friends and family all about Chris's weird stuff. But I thought of something that's kind of fun, that's kind of unique, I think, to my family, and it also leads itself to the season. So first of all, Merry Christmas and a little bit delayed Happy Hanukkah. But interesting fact about the Hobart family is we actually have 3 menorahs at the Hobart house. Now, Jacob, I know you're sitting there saying, Chris, the Hobarts aren't Jewish.
Right.
And you at home might be saying, hey, the Hobarts aren't Jewish. You are right. The Hobarts aren't Jewish. But I was taught at a young age just to kind of respect and appreciate different traditions. And that's been one that through the years, we've just always done. And it's kind of funny because we will light the menorah every year. We're not perfect at doing that. We don't say a prayer or anything with it. We just do it out of kind of a tradition. But my kids, they're still learning this because they have their friends come over and their friends will say, oh, we didn't know you were Jewish. And we're like, we're not. So anyhow, interesting fact about the Hobarts. You ready?
I'm ready.
Jacob sitting here saying, Chris, this is the last one of the year. Can we just go through it? There's a lot to talk about other than Chris's.
We've all got a little bit of holiday brain, I think, on our minds at this point. So it's okay.
That is definitely true. So what we're going to go ahead and do is we're going to get started with the Wealthologist. And, I feel like 2023 and probably 2024 and 2022 and everywhere, it seems like the conversation has been so much about the Fed.
Yeah.
And unfortunately for viewers at home today, we're going to talk about the Fed's latest actions, plus really what's happening with the economy and the markets as we head into 2024. The reality is the Fed's making such big moves that it's generational that we're talking about. The last time we saw such gigantic moves within the Fed with interest rates pushing high, we're talking about 40 plus years ago.
Yeah, about 4 decades.
So now we're dealing with it again. And as we're dealing with this again, we're kind of in this unique scenario to where it's kind of creating the new normal, and we're going to have to redefine that. So last week, Fed, they had their final meeting. Tell me, Jacob, what were the key things that we as investors and consumers need to be looking at when it comes to their conversation, what they told us?
Yeah, no, it was interesting because I think we were all, kind of to some point sitting on pins and needles waiting for the results. We did have a pretty good idea of what the Fed was going to do, and it's interesting. They have moved to an environment now where they do tend to, I don't want to say forecast, but they give an idea to the markets as to what's going to happen. And so they paused rate hikes last week, and that vote was unanimous, which I think was interesting because you don't always see that. A lot of times with Fed officials, there's some who vote one way and others who vote another way. But the unanimous vote, just tells us, okay, well, they all felt that pausing rates was the right move. And that's kind of telling into what we may see moving forward into 2024 too.
Now, if we could just get politicians to all agree on, maybe it's better that politicians don't all agree.
That's our Christmas wish for this year.
but I think I do think it's important when they all agree from an economic standpoint. It does mean that the signs that they're all looking at are all kind of pointing the same way, and it's kind of giving us the same signals. And I don't think Wall Street was really surprised, and I put out a Wealthologist weekly about that Wall Street was expecting a very low likelihood of any rate changes happening.
Right.
In fact, Wall Street now, and we're going to talk about this, but they're starting to project out when is the first drop going to happen?
Yeah.
Which is kind of exciting to think about.
It is. And I think, and I did want to spend a little bit of time on, why that's important for us when we talk about rate cuts, but a couple highlights that I just wanted to mention, from what the Fed officials had said in last week's meeting. They pointed to lower inflation for 2024, which is what we've all been saying for some time, hopefully. Yeah. The one thing that was interesting is, probably going to experience slower growth in 2024. And, what we just mentioned, looking to probably see about, 3/4 of a point of rate cuts, which just means, we've raised rates very dramatically over the last year and a half. And now we're getting to a point where rates are starting to peak finally. And we're probably going to see that roll over and start seeing the Fed cut rates moving into 2024.
Now, I think the important thing around that, though, is, when we hear cutting rates, we're not talking about getting back to that zero interest rate environment anytime soon. That's kind of almost at emergency measures at this point in time. That would just throw things totally out of whack. Yeah. Where my concern comes, and again, I know we get to discuss this as we dig in. My concern just comes that lowering interest rates. Sometimes people hear that and they think, oh, mortgages are going to be affordable again. This is still going to be a long process to get to a point where people are looking at interest rates and saying, oh, well, this feels right again.
Yeah, it's going to take some time. They even pointed to rate cuts in 2025 and 2026. I think it does raise the concern. You want to be, the Fed's in this balancing act of they don't want to reduce rates too quickly and then cause inflation down the road another year or two. That is a risk. They're balancing it, and our hope is they balance it the best that they can. But one other just quick note that I wanted to mention as far as why interest rates are so important and why rate cuts are so important. And I know we have talked about this before, and probably some of our clients have heard this. But I like to think about interest rates kind of like the financial gravity of assets. So if you think about that, the kind of an inverse relationship, if you're increasing interest rates, that tends to put downward pressure on the prices of assets and vice versa. So, if we get to a point where rates are being reduced, that should be positive for asset prices, meaning, real estate, stocks, bonds, what have you. So that's why it's so important when we're talking about rates and how that impacts our portfolios and our assets.
Which makes this year kind of an interesting year too, because we do have high interest rates, and typically we would think that gravity would pull down a lot harder than it has.
Right.
But we've had that AI factor that's kind of really driven the market in kind of a very unique way.
And the markets are forward looking. So I think they're expecting, they're kind of anticipating the Fed cutting rates because they've sort of told us that's what they're going to
do. So I guess the question that we have to ask is, what is the impact that this does really have on our economy and really now and moving forward? What should we be looking for short term and a little bit longer term?
Yeah, and it's interesting because from the Fed's perspective, and I mentioned this earlier, the growth is slowing. And so we had a really strong third quarter from a growth perspective, GDP, gross domestic product, and that's going to start slowing moving into next year. We've made some portfolio changes and adjustments to kind of be proactive and get ahead of that. And I will, before we finish, did want to talk a little bit about that as well today. But job gains have moderated a little bit. So we've still got a really strong jobs market. But since earlier in the year, we've seen jobs kind of beginning to pull back. Unemployment rate is also pretty low. And again, inflation has eased over the past year, but it is still high. I mean, we're still seeing pretty high inflation. So a couple of points that the Fed mentioned, they think inflation is going to be lower by year end of 2024, quite a bit lower than where we're at now, which is good news. Unemployment's probably a little bit higher, which is, it's okay. It's not great, but it's not terrible. But the key, I think, that we took out of this and then position portfolios accordingly is, expecting U.S. GDP growth to be lower by 2024.
Now, I think the important thing to point out here too, sometimes we hear folks say lower inflation, and I want to be clear that people aren't confused that's not deflation. That's not prices coming back down. That just means the increasing price is slowing down. We're still dealing with, quite frankly, a year and a half ago, the inflation was crazy. Right. We stack on top of that what happened this year. So inflation is going to continue to move forward. It's not like we're we're getting a breather. It's just not going so fast.
Yeah, I almost think about it kind of like the rate of change is slowing, but we still have high inflation.
Everyone's you are still going to go to the grocery store and you are still going to gripe about, I can't believe how much this cost compared to a year or 2 years ago. The good news is it's not going to be like every other week when you go to the grocery store and say, man, just a few weeks ago, it felt less expensive. So I guess probably what I think people are wondering, and what we hear quite a bit, is, does all of this new data point to recession 2024?
Yeah. And it's a great question. It's a question that we wrestle with ourselves, of course, in the positions that we're in, and managing the money that you have entrusted to us. But I think it's important, when we think about recession and the risk that brings, is to really focus on the credit cycle. Now, when I say credit cycle, I'm talking about where we're at from an interest rate perspective, because we had interest rates rising, now we're peaking, and we're probably going to see interest rates beginning to fall. And what's important, and what we really focus on here, is taking that kind of what I consider to be like a scenario-based approach, where, looking at probabilities and what could happen given where we're at and where the markets are at. And, we don't always agree on what we think may happen, because we have debates a lot of times internally on what we think could be coming down the pike from a scenario standpoint. But, it's important to try to pin down where we're at in the cycle. Ultimately, the way we look at this, we feel that there's potentially three scenarios, that could play out. One would be, I call it a higher for longer, where interest rates are higher, at least through the first half of 2024. And I'm going to touch on each of these in just a second. But the second scenario is, we do go into a recession. And then the third would be, we hit a soft landing. And those are really the different scenarios that you've probably all heard people talking about. But that's really where we feel, we could be heading. This higher for longer scenario, where rates stay higher at least through the first half of 2024. That's a scenario where the economy, I think, continues to kind of chug along. Inflation probably could be a little bit higher, a little bit stickier than we thought, and then we've got this kind of persistent volatility in stocks. And there's a lot of reasons why that could be the case. I'm not going to dig into that specifically today, but that's one scenario. The second scenario is, we hit a recession. We move into recession, which I think is pretty well. I guess the way that I think about that, if that happens, we've got high persistent inflation, higher than maybe we thought. We've got credit risk or tight credit, where again, like we've talked about with mortgage rates being high, we've got stricter bank lending standards. And again, the thing that we can't forget is just the geopolitical risk. We've got a lot of geopolitical risk out there, potential geopolitical risk.
The bank lending is the one that gets me probably most nervous, just knowing that that a lot of times people have a 5-year ARM or a 3-year ARM, and we are going to start seeing people, their mortgage rates adjust, and businesses too. When folks buy buildings, oftentimes they're buying that with a balloon note, which means you're paying a note over 5 years that's amortized over 20 years. But at the end of 5 years, that note is due, and you have to refinance it at whatever rate exists. And that is where we're probably going to see some real estate potentially, again, if rates don't come down a bit more aggressively, where we're going to start seeing the pinch of that type of stuff.
Yeah, and I think that's part of the reason why the Fed, is looking at potentially, rate cuts this year, because they're looking at some of those, indicators as well. But the third scenario is we have a soft landing. We don't move into recession, and I think that's a scenario where we likely see inflation moving down to the Fed's 2% target, which is where they want to see inflation. But we do it. Soft landing just means we do that without a significant drop in growth, if we were to do that. So again, those are our three scenarios. The one thing that's interesting, there's an indicator that talks about this is the most telegraphed recession ever, because everybody's talking about recession. and the model, because of that, the model says, well, that actually reduces the odds of a recession because of that. So, there's a lot of data, a lot of statistics out there. And again, that's why internally we don't always agree on what our scenario outcome could be. But I will say, our base case, to kind of bring this back to what we feel we're moving into. Our base case is that there is a high likelihood we could hit a mild recession next year, middle of 2024. And then we're probably going to get rate cuts, as the Fed has projected, probably around that 0.75% range for this year, for 2024. So it's really a kind of a combination, I guess, of the first scenario, which is a little bit higher for longer, and then the second scenario of potential risk of recession. Now, I guess the one thing I just wanted to, take a pause with and talk about is, if that's what we're expecting, how does that impact my portfolio, and what does that do to my investments? Well, a few of the things that we've done, I guess, some reallocation adjustments, and you have probably seen some of these trade notifications coming through within your portfolios. One of the, what I call kind of a high conviction allocation, is to rebalance into what we consider to be quality equities. And when I say quality, think more value focused or more dividend focused type investments, where quality just means they got a strong balance sheet, good free cash flow, a good competitive advantage in the marketplace or the industry that they operate in. And having an allocation to that quality tilt puts us in a position that if we were to run into a recession, that's an industry and an environment they tend to do fairly well in a recession, just because they're in a much more stronger position than some of the other industry sectors out there, invested in a way that we're going to see gains and growth, because we're still invested in good asset classes, good industries, good sectors. So that's one of the adjustments that we made. And then secondly, the other thing that I wanted to mention, a different allocation, is what we consider to be we call it like a buffered equity strategy, which just means we're trying to lower volatility in the stock market, but we're also trying to still giving ourselves good upside potential. So we can go way into the weeds with how that strategy works, and today's not the time or day to do that. But really, the way we like to think about that is say, well, we want to link our returns to the market, to the stock market, but let's just build in some buffer, build in some risk controls to the downside in case we were to run into some choppy waters or a recession, but still give our money a fighting chance for growth. That's really the way that I like to think about it. So those are just some of the adjustments that we've made. Of course, and I know we say this a lot, if you have any specific questions about your particular situation, we're happy to schedule a meeting, go through exactly how some of these changes impacts you specifically. But it's important, when we're talking about different scenarios, to have, kind of take I guess what I would consider to be more of a probability weighted approach, to say, okay, we want to build in a diversified strategy or approach that has fundamentally sound asset classes and strategies, because that's really how we gain success over time, in the markets and the economy, because none of us know exactly what's going to happen, but if we position appropriately, that's how we're going to get through whatever comes down the pike.
And I think one thing to point out in that, you had mentioned, Jacob, the use of what we call buffered equity. And we're utilizing that actually as a replacement for what we've looked at before, which is risk on, risk off.
Right.
And the reason we're doing that is, with the current economic cycle, the risk on, risk off, the indicators they're not striking at the right times. And unfortunately, what that means is we can lose some upside in that process, and that can just be frustrating, because again, we're utilizing something that has good data behind it, but if it's not in the right economic cycle, we've got to change and pivot. And we've done that. And the buffered equity is meant to be a little bit more of a well-rounded strategy, still giving some upside, but also having some downside protection built in. But it's done differently. It's a totally different strategy. We're actually really excited to bring that to the table, because we think that it will, regardless of economic cycle right now, act the way that we want it to, with the intention of what it should be doing.
Yeah. So, good point.
Well, thanks, Jacob.
Yes.
I think that's some good information as we really finish up the year and take a look at what the Fed's been talking about. Gives you something good, around the table in the upcoming week to talk with your friends and family about. You can be the smartest person at the table. Here's the tip: talk about the Fed, talk about interest rates, talk about inflation. Don't talk about politics. I have learned not to talk about politics. I always talk about politics, because what I'll do is I'll just choose the opposite side of whoever I'm talking to, just to get them mad. And it is fun. for me at least, not for them. One segment that we always do, and we're going to continue to do with Wealthologist, is the segment we call Hey Hobart. And Hey Hobart, this is where we take your questions that you send into us, or questions that we're hearing a lot in the office, and we just provide you some answers to those questions. So if you've got something that you'd like to ask us, you want some greater detail on, you want us to dive deeper with, send us an email at hello@hobartwealth.com, and we might just feature it at one of these future events. So today's question really comes around it being a new year and what happened last year. So the question is around whether or not there's any big legislative changes that might impact your money in the coming year. So you might remember at the end of 2022, I believe it was December 29th, 2022, the Secure Act 2.0 passed. And with that, that was changes to the RMD age. That was changes, just a lot of, quite frankly, a lot of good changes within the tax code, but it was just a lot. And we sent out a lot of information to our clients just to make sure that you're aware of that. But the question is, are we dealing with this again this year? Do we have these sweeping changes that are going to be like, oh my gosh, what's going on? And the good news is no. Right. There's nothing like that happening this year. A primary thing to know is that tax rates have stayed the same, but the tax brackets have shifted slightly to account for higher inflation. Now, the good news is when we slow things down, or when the government doesn't have massive changes, it actually allows us to be more active at Hobart Wealth in developing some tools. One tool that our clients tend to love is the 2024, or the tax summary. And we already have the 2024 tax summary numbers. So we are going to be sending this out to you in the next month. If you'd like a copy earlier, just because you just want to dig into it before the holidays, let us know. We can email you a copy. The things that you're going to notice on this, though, is the IRS has made some adjustments to contribution limits for your IRAs, your Roth IRAs, employer-sponsored retirement plans like your 401k. The other thing to note is that the gift tax exclusion limit for 2024 is increasing from $17,000 to $18,000, and the estate tax limit is also ticking up just a little bit. Nothing, nothing to the point where it's going to change planning for a lot of folks. Anything from your side that you know of? The nice thing is, some of you may know this, some of you may not, but one of our advisors, Corey, his wife actually works in Washington. We're trying as hard as we can to squeeze out additional information from her of any legislative changes, but she doesn't really work on that side of Washington. So she keeps telling us, guys, I really can't tell you any top secret information that will move the needle. So sorry about that. But anything from your seat?
No, I think that was everything. I mean, everything you hit was pretty much the highlights as far as what we've experienced this past year and what we could be experiencing moving into 2024.
Okay. Well, like I said, if you've got questions that you want to ask for a future Wealthologist, the Hey Hobart segment, again, email us at hello@hobartwealth.com. If you've got questions about today, what we talked about, changes within portfolios, we are always here to help, always happy to give you additional insight. You can always email us at any time, your questions about your retirement, your income, your investing, tax strategies, all of that. I just want to thank you, one, for coming today, for paying attention today, and for sending in the questions that you have sent in. I also want to thank you just as we round out the year of 2023. It has been a year of ups and downs and changes, and a lot that has gone on. But it's also been an exciting time. It's hard to believe that 2023 is over, but we at Hobart Wealth do wish you a very happy new year, very happy holidays for the rest of the year. We're looking forward to see what 2024 holds. We've made some smart strategic changes, I think, within portfolios that really allow us to adjust for 2024, which is a political year. But from all of us at Hobart Wealth, again, Happy New Year, Happy Holidays, Merry Christmas, delayed Happy Hanukkah. We hope you have a fantastic next couple of weeks, and we'll see you again in the new year. Awesome.